Hello, I'm Sebastian. Welcome to 9 Trees podcast. Today, I will summarize and review the book, The 5 Mistakes Every Investor Makes and How to Avoid Them, Getting Investing Right. By Peter Mallouk is a practical guide for everyday investors who want better results with less stress. Drawing on widely discussed principles of sound financial planning and long-term investing, the book focuses on the real reasons people underperform, behavior, inconsistent strategy, and avoidable costs. Rather than promising shortcuts, Mallouk emphasizes building a repeatable process that can withstand market noise, headlines, and emotional decision-making. The framework is designed to help readers recognize common traps like chasing hot trends, reacting to volatility, and misunderstanding risk. It also highlights how a disciplined plan, diversification, and attention to fees and taxes can matter more than predicting the next market move. Written in an accessible style, the book aims to bridge the gap between what investors know they should do and what they actually do when money and fear are involved. I will give you key takeaways from this book. Firstly, Mistake 1. Letting emotions drive decisions. A central theme is that investing mistakes are often psychological rather than mathematical. Investors tend to buy when confidence is high and prices are elevated, then sell when fear peaks and prices are depressed. This pattern is reinforced by nonstop market commentary and the natural desire to avoid loss. The book frames emotional discipline as a core investing skill, suggesting that the best portfolio is the one an investor can stick with through uncertainty. It encourages readers to expect volatility as normal, not as a signal that something is broken. Instead of reacting to short-term drops or rallies, the approach favors having predefined rules for rebalancing and risk exposure. That structure can reduce the temptation to time the market, which is notoriously difficult even for professionals. The broader lesson is that behavior can be a bigger driver of outcomes than choosing the perfect fund. By recognizing triggers such as fear, greed, and regret, readers can build habits that keep them invested long enough for compounding to work. Secondly, Mistake 2. Confusing activity with progress. Many investors equate frequent trading, constant monitoring, and tactical shifts with being responsible. The book challenges that assumption by emphasizing that more decisions can create more opportunities to be wrong, especially when decisions are based on short-term signals. It highlights how overtrading can increase costs, taxes, and the likelihood of selling winners too early or doubling down on losers for emotional reasons. A steadier plan often wins not because it is exciting, but because it is consistent. The discussion points readers toward long-horizon thinking, where the goal is not to outperform every quarter, but to meet personal objectives such as retirement funding, education, or financial independence. It also underscores that markets incorporate new information quickly, so attempts to outguess price moves tend to disappoint. In this framework, the most productive actions are setting a strategy, automating contributions, periodically rebalancing, and reviewing goals. The key shift is from chasing performance to managing what can be controlled, savings rate, asset allocation, fees, taxes, and patience. Thirdly, Mistake 3. Misunderstanding risk and diversification. The book treats risk as something to be managed intentionally, not avoided entirely or pursued blindly. Investors often misjudge risk by focusing on what feels safe in the moment, such as a familiar stock, a hot sector, or a fund that recently performed well. Yet concentration can quietly raise the chance of large losses. The book promotes diversification as a way to reduce uncompensated risk, meaning risk that does not reliably increase expected return. Diversification is presented not as owning many things, but as owning different kinds of assets that behave differently across economic conditions. It also connects risk tolerance to real-life timelines. A young investor saving for decades may be able to withstand volatility, while someone nearing a major goal may need a different balance. The message is that the right portfolio is personal and should be aligned with time horizon, cash flow needs, and the ability to stay invested during downturns. By treating asset allocation as the main driver of outcomes, the book encourages investors to prioritize balance and resilience over prediction. Fourthly, Mistake 4. Ignoring fees, taxes, and the drag on returns. A recurring point is that small frictions compound, just like returns do. The book draws attention to investment expenses, advisory fees, trading costs, and tax inefficiency as common, often overlooked reasons. Portfolios lag. When investors chase complex products or frequently change holdings, they can create hidden costs that erode long-term growth. The book encourages readers to evaluate what they are paying and what value they are receiving in exchange, whether through professional advice, planning, or portfolio management. It also emphasizes that after-tax returns are what matter in real life, so strategy should account for tax location, turnover, and realization of gains when appropriate. Even modest improvements, such as selecting lower-cost funds, minimizing unnecessary trades, and coordinating accounts with a plan can have meaningful impact over decades. The broader takeaway is that while markets cannot be controlled, costs and tax decisions can. By focusing on controllable levers, investors can improve the probability of reaching goals without taking extra risk or relying on market forecasts. Lastly, mistake 5, investing without a clear plan and accountability. The book argues that many investors fail not because they chose the wrong stock, but because they never defined what success looks like. Without a written plan, decisions are reactive, shaped by headlines and recent performance rather than personal goals. A solid plan typically includes objectives, time horizons, expected savings, target asset allocation, rebalancing rules, and guidelines for handling market declines. The book also suggests that investors benefit from accountability, whether through a trusted advisor, a structured process, or a disciplined routine. Planning is positioned as a way to connect money to life, clarifying priorities such as retirement lifestyle, family obligations, and charitable goals. When goals are explicit, it becomes easier to ignore distractions and evaluate progress rationally. The book reinforces that good investing is often boring, regular contributions, diversified exposure, periodic rebalancing, and staying the course. This topic ties the entire message together. Avoidable mistakes shrink when decisions are guided by a framework rather than feelings. With a plan, the investor becomes less dependent on predictions and more focused on consistent execution. In conclusion, this book is best suited for individual investors who want straightforward guidance, including beginners building their first long-term portfolio, busy professionals who lack time to monitor markets, and experienced investors who have been burned by chasing performance. It is also useful for anyone approaching retirement who wants to reduce decision stress and align investments with a real-world plan. The main benefit is behavioral clarity. The book helps readers identify why smart people still make costly moves, then offers a process to reduce those errors. By emphasizing discipline, diversification, and attention to fees and taxes, it can improve outcomes without requiring advanced finance knowledge. Compared with many investing books that focus on market prediction or complex strategies, this one stands out for its practical focus on what most investors can actually control. It encourages a repeatable plan that can hold up during volatility and keep investors invested long enough to benefit from compounding. For readers who want an investing approach that supports a stable life rather than constant market anxiety, it offers a compelling, actionable reason to buy and apply its lessons. If you would like to support Peter Mallouk, you can buy the book through the Amazon link I've provided in the podcast description. After reading the book, please let me know what you think and share your thoughts. See you around.